Laurence, let's drill into your portfolio right now, because it's, as you say, there has been a strategic focus on retail. You have been overweight retail. So to take us through the performance of the portfolio, which is geared towards the shopper, I suppose.
Great, thank you. Vukile is a diversified portfolio. Just over half of our portfolio is made up of retail, the balance split between industrial and offices. The retail sector that we've been focused on is more the lower income shoppers, LSMs 3 to 6. We have shopping centres such as Dobsonville, Daveyton, Phoenix. Those have done exceptionally well for us in the past, and that's an area that we're going to look to continually grow into and really tap into what we think is a rich vein of growth in the economy. On the industrial and officer side, what we've been trying to do there is look to improve the quality of our portfolio, really doing that through two angles. One is selling out the CBD properties that we have, tend to be government tenanted, riskier properties, and then at the same time looking to acquire offices in better locations, better quality properties with upgrade potential. And the $1.5 billion acquisition from Sanlam, which closed post year end, really achieved a lot of that for us. So we think overall the portfolio is starting to take better shape. It's a diversified portfolio. We overweight retail, will continue to be so, and looking to upgrade the quality of industrial and offices as we move forward.
Let's talk about vacancies right now, sitting at 5.9%. If you exclude the Randburg Square, where you've got refurbishment, so it's unfair to really include that right now, because they can't, they can't take ownership of that space. How are you managing this right now? Because you have indicated that it's a problem. We know that that the rental income has also been an issue for you. So how do you manage vacancies and the space that you do have open?
Sure. Well, I think we've been quite happy with our result operationally over this last year. We were able to achieve positive rental reversions across all three categories. Our new deals were done on budget, and I think that was a very good operational performance given the environment that we're in. The vacancies, whilst they have ticked up a bit, are certainly below industry averages. I think it's through really strong, solid management. I have a tremendous team that focus very heavily on the properties. So if you look at our vacancies and compare them to SAPOA industry trends, we're still below those trends. Also, if you compare our interim to final year vacancies, you will see an improvement. And we did see an improvement in the operating environment in the last 6 months. Certainly our retail again is looking strong. We have increased tenant demand pretty much across the whole portfolio for those centres. Offices have ticked up, but I think if one drills into that, it's one or two problematic properties as opposed to the overall portfolio experiencing undue pressure.
And that of course weighing down on your average number.
Correct. And then industrial, there has been a tick up there, and I think the more the economy starts to recover, we should see that continuing.
Are you seeing that at all? Because we talk to the CEOs, we've spoken to a lot of consumer companies, and they're saying that consumers are still under pressure. We saw positive Q1 GDP figure coming through today. So what are you seeing on the ground?
Very, very tentative, very cautious steps. I would say the office market probably has troughed. We haven't seen a worsening in the last 6 months, maybe a slight improvement. Industrial, there has been greater activity of new leases being signed, but typically shorter leases. People are nervous, not wanting to commit for a longer period. Retail, we're seeing a bit of a different picture. I think our market has different drivers. It's more the lower income consumer. I think there's a shift from informal to formal retail. It's government grants, it's remittances that tends to drive that market. So we still have been seeing good demand and good trading volumes coming through in that end of the market.
So as at the end of the results period, you had 72 properties worth 6.1 billion rand. Do we add the Sanlam properties onto that 72 properties?
Correct. So it's another 20 properties, another 1.5 billion. So overall assets of around 7.6 billion. And
you've said that this is the start perhaps of an acquisitive period for you. So if you're looking at targeting low income groups in the retail space right now, where have you earmarked? How big do you want your portfolio to get?
We've set ourselves some targets where we want to grow to.
Can you give us an idea?
We'd like to be sort of playing in the 10 billion plus category. So we've still got some way to grow over the next few years. What we have done, a lot of our work at the moment is going on the retail side, looking at new shopping centres where we can buy into new developments. We have closed one deal for a centre in Hammersdale in KZN, which opens about a year from now. That's about a 200 million rand deal for us in that market. We also have concluded a joint venture with McCormick Property Group, who are one of the preeminent property developers in the lower income space, and that's around 5 properties that will come to the market. So we have built a very good pipeline that we're currently evaluating. It's a question of how we bring those properties to market over the next 2-3 years. but we do see growth there. We're trying to spread it across the country as much as we can and make sure we're not sort of getting too much concentration risk in any one area.
Which is the most exciting area for you right now in terms of growth in the low LSM retail space?
Do you mean geographically?
Yeah.
KZN is looking good. We think there is probably an underrepresentation of formal retail relative to informal in this market, and quite a lot of development opportunities. So probably about 3 to 4 centres that we're looking at in that area.
Well,